The S&P got wrecked on Friday, trading down 1.71% during the trading session, closing at 6,013. This is just above the big 6,000 level. We actually highlighted this level in last Wednesday's video, suggesting that if we were to get a pullback down into this 6,000 zone, this would be a fantastic area to re-enter long positions for a potential bounce. If we look back over the last couple of months, we can see how important this 6,000 level has been. And we can actually see just how price has been oscillating back and forth right around that level. Since the middle of January, this has really been mostly a support zone. And here we are again at this point. The 6,000 level, of course, saw the largest volume coming in the options market. Friday was OPEX, so it was the big monthly options expiration for February. So all of this gamma exposure that you see here in the purple bars is mostly zero DTE. Coming over here to our gamma exposure data graph, we have the zero DTE filter on. So this is showing us everything from Friday's expiration. And if we look here, this just gives you a clearer picture. The 6,000 strike has nearly 600 million negative gamma exposure, and that's on a net basis. Likewise, if we come over here to the 60-10 strike, there's negative 390 million. So those two strikes combined are nearly 1 billion gamma exposure. And if we just flip over to our total gamma exposure, this is looking across all expirations in the options chain. Total gamma is actually at negative 1.2 billion. So negative 1 billion gamma exposure is actually rolling off at these strikes. You can see this is where everything is concentrated, and as I just showed, that was all zero DTE on Friday. So options expiration plus all the zero DTE GEX rolling off last Friday is really going to clear the deck. And so this gives investors and traders an opportunity to reposition themselves and decide, do they want to reassert their short positions, or are they going to use this opportunity to start entering long positions heading into March? From our perspective, we see this as a major support zone between 6,000 and 5,900. So anywhere in this area, we want to use this zone to look for long opportunities, both in the broad market indices as well as on individual names, entering long positions for a potential bounce out of this support zone. At the same time, however, we do want to maintain hedges. So we've got the SPY pulled up, and I just want to show this to you so you can get a sense of our portfolio strategy. So as I mentioned, we'll be looking to enter long positions if we get any further dip into this zone here between 590 and 600 on SPY, or 5,900 and 6,000 on SPX. Long positions while maintaining hedges. And currently in our portfolio, we have a 600, 585, put debit spread. So that effectively gives us a market hedge in this zone. So if the S&P were to continue going lower, our hedge would protect us in this zone. And so we basically position ourselves that our hedge can either partially or fully offset losses in the rest of our portfolio. And personally, I think this is the right approach. We're still in a major uptrend if we look at the indices overall. And so if that uptrend continues, our long positions that we initiate here coming into Monday and Tuesday will perform really well. However, if we're wrong, our hedge will take over, and the profits that we get from this put debit spread will offset most of the losses and potentially even make us gains depending on the timeline of any future sell-off. So if you're interested in following along as we trade in our own portfolio, you can check out our community Discord. I'll put a link in the description below. Here's a post that we made on February 19th, so that was last Wednesday. We actually rolled our existing hedge. We had a hedge that was expiring on February 21st. We actually rolled that last Wednesday. It was the 600 585 put debit spread, and we rolled that out to the March 21st expiration in our portfolio. And we can just zoom in here to our chart at the time. SPY was trading at 612. We were approaching this upper dealer cluster zone, so we knew there was the potential for some resistance or some selling pressure to kick in at those levels. And so we thought, hey, market protection is really cheap down at this level. If the market sells off coming into OPEX or after OPEX, this will at least give us some partial hedge. And in fact, that's exactly what happened. We saw the big sell-off on Friday, and we're coming right into this zone here. And so I love being in this position where we've already got our hedge in place, and now we can take long positions using option strategies to give us outsized returns if the market bounces at this point. If the market continues selling off, that's okay because, again, we've got our hedge in place. Next, let's take a look at Bitcoin. Bitcoin hanging in there, trading around that 95,000 level. If you've watched our videos before, you know Bitcoin and crypto in general is one of our favorite indicators to assess risk on sentiment. So the fact that Bitcoin did not have a major collapse here, I think is really telling. Despite the market sell-off, Bitcoin maintaining in this support zone right around the 95,000 level. This is our lower dealer cluster zone, so we could see a potential bounce here. We've basically been bouncing at this level for the last 3 weeks or so. I do give it some room down to the 90,000 level, so basically between 90,000 and 92,000. We saw previous support multiple times going all the way back to November, so there is the potential that we could see a slight dip further through our dealer cluster zone. That's always possible with Bitcoin because of the high volatility. However, I think anywhere in this range is an interesting long opportunity, in particular because of the fact that Bitcoin did not get destroyed in Friday's sell-off, and it's been hanging in there through this weekend. In addition, we see mostly positive gamma exposure between the 95,000 strike and the 110,000 strike. So this just skews the odds to the upside slightly based on the options market for Bitcoin. So next, let's go through a number of names that were beaten up on Friday and see if we can find some opportunities. First, we'll start with NVIDIA. NVIDIA really didn't get hit that bad, down 3.65%, trading right at the 135 level. We've been trading NVIDIA long since this initial drop on the DeepSeek AI news. It chopped around a little bit for about a week or two and then really rocketed off. We got a couple of big trades here in this zone, taking some nice profits. We've been looking for a pullback ever since we tagged this 140 strike. If you go back to our previous videos, we were highlighting the large gamma exposure concentration at the 140 strike. That has since moved higher. We now see the largest concentration is at the 150 strike. So we're going to be watching to see how the gamma exposure data evolves into next week after this big monthly OPEX cycle rolls off. However, this sell-off that we had on Friday looks like a really interesting opportunity. I think anywhere between 130 and 135, if we can get price to just pull back a little bit, let's say Monday morning or into Tuesday, I think that's going to open up a really interesting long opportunity, particularly if this gamma exposure to the upside remains in place. This could be a potential bounce zone, and we can see this 130 strike was very important initially as a resistance point after the DeepSeek AI news, and then finally breaking above that and then serving as support multiple times, and we may be coming back down to that level here soon. So I think anywhere between 130 and 135 looks good for an option strategy, and that's something we'll be looking for to enter into this week for a potential long play back into this 150 strike. Again, if these are the kind of strategies and setups you're looking to learn more about and learn our overall philosophy for portfolio strategy, be sure to check out the links in the description below. Next, let's take a look at Google. Google trading below the 180 level. We've been watching Google and trading Google for the last couple of months. We took a number of trades focusing on this gamma exposure concentrated at the 200 strike. Price basically just kept coming right back into this 200 strike level before the earnings collapse at the beginning of February. Now it looks like we are entering a really interesting zone, potentially some sort of small capitulation here into our lower dealer cluster zone. The 180 strike looks like a potential support zone. The gamma exposure at that level in combination with all the volume we saw between the 180 and 200 strike looks really interesting to me. This from a risk reward standpoint is what I love to see. price coming down into our lower dealer cluster zone for a potential bounce. So we've got a good 3 to 4 weeks heading into the March 21st OPEX. And so the potential for a bounce back into this 200 strike with a large gamma exposure concentration, I think, is pretty high here. And so from a risk reward standpoint, we can enter an option strategy that is relatively low cost and can generate potentially outsized returns if we do see momentum come back into play over the next coming weeks. So I really love these setups. That's why we highlight these dealer cluster zones. And that's also why we focus on options volume by strike and track it on a daily basis. Next, let's take a look at Apple. Apple coming out of Friday's trading session relatively unscathed, almost flat on the day, right at this 245 level. We've noted in a number of our videos last week the importance of this 245 level. We came right into it here in mid-February, and basically for the last week, we've just been bumping up against that 245 strike. We also have been pointing out the growing gamma exposure at the 250 to 260 strike, and this is something that we've actually been positioning for in our portfolio, which you can follow along in our community Discord. And so the fact that we did not see a big pullback in Apple on Friday with the rest of the market gives me a lot of confidence that the gamma exposure is going to continue remaining sticky heading into the March expiration. So as I mentioned, we're already positioned for a move up into this level. I also love to see the volume that came in. This is between the 245 and 250 strike. So big volume, all trading at where Apple closed and higher in the options market. That's what we want to see. We want to see participants trading at the current levels and higher as opposed to lower strikes. So I've basically just walked you through the game plan over the next several weeks. We've identified multiple long opportunities, and I've given you several examples in NVIDIA, Google, etc. I've also described how we hedge our portfolio. So we have exposure to the upside in case the market bounces from here. If it doesn't, because we can't predict the future with 100% certainty, and that's why we manage a portfolio strategy. And so in the case that we're wrong, we have a market hedge in place. This is a very low cost hedge. So in the case that we're wrong, our hedge is likely to have a pretty large payout if the market continues lower, and that's going to offset at least partially any losses we have in these upside plays that we're putting on. And depending on the timing of any potential sell-off, that hedge could actually generate profits in our overall portfolio. So we have multiple scenarios here where we can make money, and that's how you got to think as a trader. You've got to position yourself to make money in multiple scenarios. So we've got our base case scenario, which is a market bounce out of this zone, and we have identified a number of opportunities where we can make outsized returns if the market bounces, because we can position ourselves in relatively low cost option strategies that have high return potential. On the flip side, if the market continues lower, we've already got a low cost hedge in place that gives us market protection down to the 585 level. Remember, we've got that 600 585 put debit spread that we put on last Wednesday. So that's going to help protect our overall portfolio, all the positions that we're putting on. We'll adjust that hedge as we need to over the coming days and weeks, but that's ultimately our game plan as we come to this all important point here following options expiration at this big 600 strike on SPY, 6,000 strike on the S&P 500. And if you're interested in accessing our gamma exposure dashboard and our option flow analytics tools, head on over to geeksoffinance.com. We are also rolling out our algorithmic trading strategies along with backtest results and research that you can incorporate into your own strategy. We'll be rolling that out later this week. You can head on over to geeksoffinance.com and get access to all of that. You can also get $300 off our yearly Portfolio Manager tier subscription. Use code WINTER2025 at checkout. We're running this promo for just a few more days. We do have a few spots remaining, so take advantage of that while you can. Members also get access to all of our premium channels in Discord. You can follow along with what we're trading, the moves we're making in our portfolio, strategy sessions, and there's also a ton of great traders in there sharing their own trade setups and their own strategies as well. So you definitely don't want to miss that. Link in the description below. Thanks so much everybody for watching, and we'll see you guys in the next video.